Guys, this is Ben Naumann. Today we're going to talk about what is depreciation, what you need to know about it, and how you can best use it. Alright, so guys, what is depreciation? The government, which is really our business partner in any deal, if we know it or not, the government understands that all properties lose value over time, as in the actual structures of the buildings. So buildings deteriorate over time, such as the carpet and the roofing. All this stuff needs to be replaced. So depreciation is the write-off that we're getting for the building deteriorating over time on our asset. What this does not cover is it doesn't cover the land, because land does not lose value, or that land doesn't get worse over time. So, for instance, in this example, we have a $250,000 house right here. And what did we talk about? We talked about that the land is not something we can depreciate. So in this example, the house is $250,000. We are telling the government, however we need to, that the land is worth $25,000. So our tax rate on this property, or our basis for depreciation, is $225,000. And on residential properties only, you depreciate them over 27 years. So we are going to take $225,000, we're going to divide that by 27 years, and we get $8,333.33. So how does that work? If we have income from this property, after we have say we usually get a loan on all of our properties, after we pay everything, say we have a net operating income or a net profit of $10,000, for instance, on this property per year, we're able to write off in passive losses $8,333 a year. That is powerful. And then we have another example here, just so you can see the true power of this. This is an $850,000 small apartment complex. On this one, we're going to put the land value at $50,000. So we're going to take the $850 minus $50,000 land value, $800,000. We're going to divide that by 27 years, and we get $29,629.62 a year that we can claim as passive losses on this investment. So there is a downside toward taking this depreciation that we do need to be aware of. When we take a passive loss against the property, that is going to lower our basis in the property. So say one day when we sell the property, say we sell this apartment building 5 years from now, we would have a larger capital gain on that property. From there, you could write that capital gain off if you're still buying other properties, depreciation against other properties, or you could 1031 this into another property if you didn't want to pay any of the capital gain or the taxes on it. So we have a couple different ways here, but in a short story, we all know that real estate has significant tax benefits over time. Land ownership and ownership of properties has been a token for the wealthy in this, really the wealthy in this world. And it's very important that we need to try to buy as much properties as we can, because this is the tool that the wealthy have been using for many years, and we don't want to keep that gap of the middle class to keep shrinking. Also, thing number 2 about depreciation, this 27 years is for residential properties only. If we go out and we decide we want to buy a strip center, a warehouse, a Jiffy Lube, an oil change place, these different small commercial buildings, that real estate is actually going to be depreciated over 39 years. So we're still going to get depreciation. It's going to be over a little bit of a longer time frame. So that's something to take into account. You see a lot of very active real estate investors going out and talking about accelerated depreciation. This is depreciation on steroids. So how does accelerated depreciation work? So the way accelerated depreciation works is you really only want to do this on a more expensive property. So most likely a property that's over $250,000. You're going to hire a professional and they're going to come in and they're going to look at the roof, they're going to look at the carpets, and they're going to do a stronger cost analysis or a cost segregation study, trying to get every dime of depreciation that you can. And we are seeing other real estate professionals in the industry writing off up to 20% of the property value in the first 1 to 2 years. And keep in mind, most of the people that are good for using that accelerated depreciation, they're very active investors. And so, for instance, say they wanted to claim accelerated depreciation on their apartment complex, and say they buy a large apartment complex and they're able to claim $100,000 passive loss that year. That, for real estate professionals, that can go directly against their earned income. So say if that real estate professional earns $100,000 that year, but they took $100,000 passive loss with their accelerated depreciation, they paid no taxes that year. If you're a doctor right now, you're an attorney, you're working a normal job, you're going to be taxed differently. So you can only write off your passive losses against your passive gains, but not your income as a school teacher. That writing off of the full passive losses against your active income, that only works if you're a real estate professional. And a real estate professional, by the IRS's rules, is working at least 15 hours a week in their real estate business, whatever that is, such as an agent, investor, managing their properties, etc., etc. Don't worry though, because if you're a doctor, if you're a lawyer, and you're not an active real estate investor, you can still get a write-off against any passive, other passive income you have from dividends from stocks, etc., etc. And if you end up not taking that depreciation that year, that's fine. Then you could still use that depreciation at a further date, and or your cost basis is going to be better in the property for in the future. Hope y'all like this video. Definitely like, subscribe, and comment what you want to see next if you like this video, and I will talk with y'all soon.